Good afternoon, everyone. This is Brennan Decimo with Decimo Wealth Consulting. If you've been following along on this series, we've been covering bonds and bond funds and the role that they play in a retirement portfolio. I had a client of mine ask, well, what about ETF ladders and target maturity bond ETFs? So the third part of this series is talking about the role that a target maturity bond ETF plays for retirees. So I'm going to start. Let's say you like the idea of the bond ladder. Buying that individual bond that matures, a couple of them that mature over the next several years, which is giving you predictable income, and you know that it's going to mature at a set time period. But managing credit risk or buying, dozens of bonds to diversify is just something that feels overwhelming to you. You value simplicity. We're looking for more predictability, but we still value the simplicity of a bond fund. That's really where these ETF target maturity ladders can play a role. So the benefit of a target date ETF, bond ETF, a couple companies have them. iShares iBonds is a popular one. Invesco Bullet is a popular one. But this is really a hybrid of both bond funds and a bond ladder. So you get the benefit of diversification and credit oversight that you would from a bond fund. But with the bond ladder, you know that the majority of bonds in that fund are maturing at a set date. So in our last video, we talked about bond funds. They may have, bonds that mature at all different times. So we don't have that predictable time period of getting our principal back. Well, with the target date, we now add that. So you can buy a target maturity bond fund that matures next year, the following year, 5 years. So we can create that ladder, but now we have the simplicity of the fund, we have credit oversight, and we have diversification of multiple issuers. So a couple of benefits. One, predictable return of capital. So best of both worlds, where we want the bond that pays at a set time period. It becomes much more transparent from a duration and risk standpoint than a normal bond fund. But it also is going to give you that diversification. So these funds are typically holding investment grade bonds or municipals. They are very liquid, so you can get out of them earlier. So an individual bond may have less liquidity. There may not be someone on the other side of the trade. ETFs are substantially more liquid. So you would experience a little bit more interest rate risk, but you can get out of it earlier. So if you're someone that is retired, you want more predictable income, but you want simplicity and diversification, then an ETF target bond ladder can really play a good role in the portfolio. So if this is something that you need help with, or you want to design one for your cash flow, that's how we help retirees. If you find the video helpful, hit subscribe. And if you have topics that you want me to expand on, put them in the comments. I hope everyone has a wonderful day.